Now, this session aims to give you a fly-on-the-wall glimpse of what goes on in the minds of a chief investment officer. I don't know whether maybe that's gilding the lily a little bit, but it certainly is an inaugural panel, a CIO panel, and the idea is to have a look at the process behind investment decisions, the different priorities for CIOs, and how the ESG considerations affect allocations. So if you could welcome to the stage for this session Mark Delaney, Deputy Chief Executive and Chief Investment Officer at AustralianSuper. Mark has the formidable responsibility of investing currently around $146 billion of members' retirement savings. Sonya Sawtell-Rickson, who's Chief Investment Officer at HESTA, and Sonya was appointed to the role in July 2017. She's responsible for HESTA's $50 billion global investment program. John Pearce, who's Chief Investment Officer at UniSuper, which is the super fund, we heard about it earlier, that works for Australia's higher education sector. It's got more than 410,000 members and over $73 billion in net funds. And your moderator for this session is Fiona Trafford-Walker, a Director of Frontier Advisors. Fiona is a highly respected investment consultant. She provides strategic advice across the Frontier client base and is a member of the Investment Committee and Governance Advisory teams with Frontier. Please welcome our panel, and over to you, Fiona. Thank you.
Hey, thank you very much, Ali. Well, as you've heard from introductions, we have three really significant investors here with us today, and as part of a growing and a significant part of our financial services sector, the profit to member space. We've talked a lot today about some very important themes: climate change, growing inequality, the Royal Commission, trust, community expectations. But what I'd like to do now is to start to talk about a few things that might be worrying you or keeping you up at night that are not those things. So just some new and different things that might be on your minds that you think about yourself as CIOs and as your organisations, as they fit into society, and as you think about asset owners in the next 5 to 10 years. So we'll keep it very informal, and who would like to go first? John?
Happy to kick off. Yeah, well, to me, what I think is the single biggest risk for Australian superannuants over the next 5, 10, maybe even longer years is how Australia negotiates the potential for an economic or even political Cold War between the US and China. Right? And it is so important for us, when the elephants fight, the ants get trampled, and we're an ant in this. And the problem is, I just don't know, as a chief investment officer, how do you actually hedge against that as an Australian investor? It's almost impossible. We are beholden to this, and I question whether we've got the people, the right people in Canberra to negotiate this. We're making decisions. We would have to hitch our star to the US, and the repercussions of that we don't want to think about if indeed it gets to where we've got to pick sides. Let's hope we don't have to pick sides. Let's hope we do have the politicians that negotiate this. Otherwise, we've got a problem with pretty much every single export we've got.
Sonya?
Look, I think, excuse me, the thing that I would point to is what is being termed in the industry as the new normal, which is this environment of very low cash rates, low real yields. And what we've seen is a lot of investment markets reprice to that new environment, which means lower returns going forward. And if you think about our job as aggregating and investing retirement savings to generate an income in retirement, generating the wealth, the retirement wealth to be able to convert to income is more challenging in a world where earnings are going to be lower. But then being able to convert that into an income stream when cash rates are so much lower than what we've seen in the last 50 years is also a big challenge, and something that I think the industry is still grappling with.
Political risk, low interest rates. Mark, what keeps you up at night?
The danger of coming third is they've picked off the two good topics. I agree with both of them. I think the only one I'll add is this evolving social consensus as to how society operates. And there's all these different manifestations of it, but if you think of the extreme being the rise in 1980 of that, if you like, that neoclassical consensus between Thatcher and Reagan and the role of markets and disciplines and deregulation and whatever. And that's now being replaced by some sort of broader social contract and social licence and whatever. So the fundamental basis by which business is conducted and how society is operating is evolving. And our job is to look ahead of that, not be caught behind it. And in some things we're being caught behind, hopefully some things like climate change and whatever, but we're a little bit ahead of it. But that evolving social contract is something which I think we're going to have to get our mind around.
So that's a good segue to another topic, which is about changing community expectations, about transparency, and the spotlight turning on you, not only as organisations, large investors, but as individuals. I'm just wondering if you've had any thoughts about what that might look like. You are, regularly in the press, either as the organisation or as the individual. Photos of you as individuals now. What does it mean to you as investors to think about your role in that? Community expectations, transparency, that spotlight, if you like, from the media, which may or may not always be correct. So how do you think about those things?
It's a great question. And I think, it's not one that wasn't unexpected. As the industry has grown, we're approaching $3 trillion today, as our funds have grown, I think the requirement for us to demonstrate solid and good stewardship and continue to earn the trust of our members and of our regulators and of our industry is critical. It's something we take very seriously and spend a lot of time, as Mark says, trying to get ahead of this and understand what does leadership in this market look like and what level of transparency should we be advocating and demonstrating to show that we use our voice externally to drive the change that we think our members want to see, but we also use our leadership in the industry to role model that change.
Just, we do have to caution though in terms of, what we can actually deliver. At the end of the day, we're not elected by the public, all right? So, we have politicians that legislate, and we've got to make sure that we work within the boundaries of that legislation. So I think sometimes when people see super funds as a potential instrument of public policy, they're missing the fact that super funds are actually just it's a pot of deferred income, right? It doesn't actually belong to us. It belongs to members, and members are primarily interested in long-term financial outcomes. Okay, so we can't walk away from that. So we have to operate ethically and morally, etc., meet higher community standards, but we can't step away from that fiduciary duty. At the end of the day, the politicians are the ones that are elected to make the rules.
That's true, but I think you can argue that politics and regulation does typically lag what might be expected and community expectations and what actually is the right thing to do. And as Michael Rice says, the super funds will collectively hold a lot of economic power. So I agree with everything you said, but what do you do with that power and how will you use that power?
Well, as I said, to make sure that we've got long-term sustainable financial outcomes for our members. That's everything that we have to do.
You or Mark?
It's an interesting question, Fiona.
Thank you, Mark.
Look, I don't worry too much about the press. I think what I liked about when I went to work at STA, then as AustralianSuper, is that you can work for an organisation whose values align with your own personal values and how you'd like to see money managed and what you're doing for others. And that's personally really fulfilling. And hopefully, if I'm good enough, generates good outcome for members. And if not, they should get rid of me. And so I think that anchor of really just focusing on what's best for others just stands you in good stead when you come to all these cross currents of what's going on around all these different topics. And it gives you the confidence to handle all the responsibilities, I think, which go with the job and all the media and everything else around that. So there's kind of a pride almost that you're a trustee of other people's money, you've got fiduciary responsibility, and it's something we take very seriously rather than give lip service to.
Okay. One thing I've noticed over excuse me, the time I've been in the industry, is we used to just call you super funds, whereas now then we started to call you fiduciaries, and now we call you asset owners and stewards and those sorts of words. So there's quite a significant change in the language used to describe who you are and what you do and how important you are. Do you ever think about what that means? Is that a burden? Is it, you've talked about really being a privilege, I think, in the answers, but how do you think about that change in responsibility and, you know, as indicated by that change in language?
I still think of ourselves as a super fund. I think it's really important. So we have, in investments, we have 10 guiding principles. It's principles that were agreed between myself and team members after working with each other for about 3 or 4 years, and say, what are the principles that we want to be bound by? And the first principle is superannuation equals life savings, right? And that sounds really motherhood, right? You know, it's a good, feel-good thing about it, but it sets and train a whole bunch of decisions, okay, that are really important. So if you start forgetting that you're a super fund and protecting and enhancing life savings, you start to think of yourself as just managing a pot of capital, right? And, you know, there's just numbers, etc. I think it's really important that we still remember that we're a super fund, right? And it's life savings. And if, you know, I use this sort of, you know, if you wouldn't put your parents' money in this, don't do it.
Yeah, that's a great test. Yeah, yeah. Mark or Sonya?
And look, excuse me. As an asset owner, you know, we do think more broadly, I think, about our responsibilities. We know our members have a very long horizon from when they first join our fund to the point that they retire, and then the point through that they're taking their retirement savings. So we've got multi-decade capital and investment and return generation, and sometimes multi-generational, because these assets will continue to transition and sometimes that capital will continue to invest. So, you know, we are long horizon. We are also, you know, exposed to this global financial system and financial risk. And so for us, it's not about increasing our share of the pie, you know, singularly. It's about growing the pie and making sure that, you know, our members' capital is being used to drive long-term economic growth and long-term sustainable business performance. The other thing I'd say about HESTA is our members are in the health and community services sector. They tend to be have very high expectations on, you know, what their capital is invested in and used for, high hurdles on social justice. They work in the caring profession. And so they very much expect us not just to invest their capital for financial return, but also to impact on the environment and the society and the economy that they retire into. So I think they want to see us having positive impact along with financial outcomes.
Mark?
I agree with that.
Yeah, okay.
You go first next time, mate.
Yeah, I think it's your turn. Executive remuneration.
Oh, beauty.
Not of listed company CEOs, but of internal teams inside super funds and asset owners. You know, that actually, you know, it's published now. It's as Sonya said, it's out there. But what's your view on how that will evolve on the relationship between how you and your team get remunerated, and not only investment outcomes, but culture and conduct risk and some of those non-financial measures that we've been speaking about today?
I agree.
There's two parts to the question. I'll answer the easy one first, and I'll think about the second one as I'm going. Culture, conduct, risk management, it's all going to be wrapped up in this executive accountability regime, and will flow through to members of the investment team and senior members of the pension of the superannuation fund. So I think that's coming to superannuation. It's highly appropriate, and they're really categories of... when we look at external managers, I'm fond of saying that people issues lead performance issues. And so if there's issues with the people, sooner or later there'll be issues with the performance. And those things you talked about are really people issues within the organisation. And that is really, if you like, a deposit on future deterioration and performance. And so I think it's very relevant to incorporate them into the framework. Mm-hmm. Remuneration, gosh, it's a hard question. It's a balancing act between treating the members who give us the money, and their hard-earned savings they are, and people who earn a lot less than people in the investment teams at the funds, treating their money with the utmost respect and our ability to attract and retain the talent we need to generate the investment outcomes we seek. And it's always a tussle between the two, but we're not in the business of making investment staff rich. We're in the business of making our members rich. Whereas if you're in a fund management business, you're in the business of making yourself rich in the fund management business, and there might be something left over for the customers.
But we heard on the director panel this morning that it's a global market, war for talent. You know, you go down your list, you've got to cross off 7 people because you can't afford them. As though that's kind of a bad thing. You know, I don't actually necessarily think that is a bad thing. I think, well, if you can't afford someone, there's lots and lots of people. There's lots of ways you can build a really good investment team. But how are you going to compete for talent? You know, the numbers are out there. You know, you'll get just spiralling upwards in remuneration, I think, because people will see, well, Mark gets paid this and Sonya that and John this, and well, I want what she's having and all that sort of thing. So how do you deal with that challenge? You know, I guess you've got things like the overarching purpose of what you do, and you've talked about that, and that's really critical. But what about the totality of, you know, trying to bring talent in when you still have this remuneration and the dollar challenge, if you like?
So I thought for a long time it's illusory to think that hiring an external agent at 5 times the amount you pay internal staff is doing the right thing. It's just easier from a governance perspective, but it is feeding them illusory. And external management runs at 4 times the cost of internal management or something. It's all up. So it is just illusory, and we can just feel better about ourselves, but we don't really do anything for members. So I think we have to stare into that and work our way through that with all the relevant stakeholders and come to the best outcome for the members, but not make false separations. So I'm not quite sure you can build a better portfolio than that. Do funds compete against each other for staff? No, not now. I don't think.
I'm not sure about that.
Oh, there you go.
There you go, a bit of controversy late in the day.
What do you think, Fiona?
Well, apart from the person who just spoke from UniSuper, 50% uplift in salary.
I think anecdotally and direct observation, you know, there are people that are in the system, and you know the REM does go up in increments as you go from one to the other. So you are seeing a bit of that spiralling, I think.
It just, I totally agree, by the way, with Mark. You know, trustee boards have got get their mind around. They have a lot of comfort with paying a fee, right, versus, you know, of millions of dollars versus paying a salary of $500,000, right? And you know, that's just totally irrational.
Well, it's not if you allow for the fact that they have externalised risk. That's hard to say with braces. They have externalised risk.
No, I disagree.
Yeah, okay.
As a matter of fact, agency risk is the most underrated risk in the market, right? We think that because we're handing it off to some other manager, it's externalised. It's not. As a matter of fact, I find it a lot more risky. You know, when I've got my internal managers, they're sitting within, you know, 20 yards, and we have conversations every day. I know what they're like, etc. I gave the example when we're starting in-house management to our certain members on our board that were quite nervous about this whole thing. And I said, look, I'll give you 2 scenarios here. We've got $2 billion in private equity, $1 billion in offshore private equity. And I'm going to be really honest with you. I actually don't really know what they do. Right? Now, I inherited this. And, you know, it's commitments, and they can draw down the capital when they want. I'm not really sure what they do. I don't know if they're good people or bad people. I assume they're good people. I assume the DD's been done, etc. But we're stuck. Compare that to $2 billion managed by people that are working within 20 metres of me, that I talk to every day, etc. I know exactly what they're doing. You're telling me this is riskier than that? They came around to it really quickly. And it was the starkest of examples. Agency risk is really underrated risk in this market. In terms of attracting people, a couple of things. You know, why, you know, how, I think we're in a sweet spot at the moment because the sell side is actually really struggling. So we're getting a lot of talent on the market that we wouldn't have seen, you know, 3 years ago, 5 years ago. So it's a sweet spot. But why are they attracted? Well, firstly, they get to do what they love doing, managing money. Right. So that's a huge incentive. You know, if you're telling people instead of going out and having to sell stuff every day, and usually the really good analysts are the ones that the sell side want to go out and sell. So no, you can just come and just pick great stocks. Right? That's all you have to do. You don't have to sell anything to anyone. You know, you can travel when you want to, etc. Tell you what, they all take pay cuts to do that, right? And that's been a huge proposition for them. This notion of actually working for a profit for members, I personally, you know, I've come from the dark side. You know, I used to, it was at Colonial with the retail funds, and where we used to get paid a lot more, by the way. And you know, I personally couldn't believe how liberating it would be working for a profit for members business. You know, it's binary. You know, if it's not the right thing to do for members, you don't do it, right? You don't have this juggling act you have to play. And I think, you know, a lot of professionals, when they get to my age, you know, they've made a bit of dough, etc. These sort of things become really, really important. So I think it's a bigger proposition than, you know, I don't necessarily see that salaries have to spiral out of control to maintain that proposition.
Yep. Sonya?
Yeah, I think the only other thing that I would add is culture is a big part of it, and I think to your point about how do you maintain a culture where it's member-centric, it's profit for members, the decision's always governed by that. And I think the answer is you recruit really well, and culture is a huge part of our recruitment process and one of our hurdles. You know, if we find people that are great investors but not a good culture fit, then they don't get through the door. I think secondly, you just make sure you live it every day, you bring it to life every day, you give them exposure to your members, exposure to your employers, and you make them understand our industry and the difference they're making every day to our members' retirement outcomes. And that's a commitment and it's an effort. It's a time commitment to tell those stories and bring it to life, but I think it's critical to our success.
So if you think about the next 5 to 10 years, you know, how do you see the role of each of your organisations as owners of assets in terms of the positions you're going to take, the size of investments you'll make, the importance you'll be in the listed market? What does that mean for governance? Will you want seats on the boards of the companies you invest in? So what does active ownership look like for each of you? Maybe Sonya, you want to go first? Given
one of the big ones might want to go first.
Mark, whoever.
Look, I think, so looking forward for the next sort of 5 to 10 years, we're spending a lot of time aligning behind the SDGs and making sure that we understand our impact and the difference that our capital can make for those initiatives. I think part of that is actually, you know, if you think about long-term investors that are getting larger in size and representing a larger proportion of global capital, what I would like to think is that the companies will start to understand us better through our engagement. They will understand the things that matter to us. They will understand that quarterly earnings cycle is really not our main game. They will maybe adjust to our proposals on longer-term reporting, longer-term integrated reporting on, you know, what is really driving their comparative advantage. You know, we want to see 10-year strategies. You know, we want to understand the directions of their businesses and how they're investing today for outcomes in the future. So for me, and we're already seeing this, like with Unilever, I think it's a great example where they've come out and said, we want long-term investors. And if you're a short-term investor, then you're not going to really be happy with us because we're not going to give you the reporting we want. We're not going to be making decisions on short-term time horizons. And they were very open with the market on that position. And I think, you know, ideally going forward, we will find more companies that are willing to put a stake in the sand and align behind long-term capital because, you know, ultimately it is about long-term wealth creation.
We're all likely to become much larger over the next 10 years, as we have become much larger over the last 10 years. And an outworking of that is I think the percentage of assets invested in Australia will continue to decline and the percentage invested overseas will go up. So we'll end up with this dual track process whereby we'll be large in Australia but still only mid-sized internationally with other very large pools of capital. So I think we'll have this dual operating rhythm whereby we'll be able to consider questions like putting people on boards if we have sufficient stake. It's a worthwhile thing to do in Australia, but that won't exist internationally. So international will still have to build alliances and networks the same way we had to do in Australia 15 years ago. but in Australia itself we'll be able to stand much more on our own feet and hopefully make a bigger contribution.
Yeah, I think the global piece is the big difference next 3 years versus the last 3 years. The big inflows. Mark's bigger inflows than us, but we're getting pretty big inflows as well. And pretty much, I can't recall a net new dollar going to the Australian market for the last 18 months. And net flow is probably going to go offshore.
So what do you think that means for capital markets here?
Oh, it'll be fine. It's absolutely fine. It's just that, once you're growing faster than the market, it's just where the marginal dollar goes. But I'm pretty positive about the Australian capital markets. We punch, like we do in a lot of things, we punch above our weight. 16 is last year, was it? 16 Israeli companies, tech companies listed on the ASX. Small, but hey, that's punching above your weight, right? We're a big owner of the ASX, so I've got to give them a plug.
Talk them up a bit. We talked a little bit during the day about the 4 corporate governance areas that ACSI's recently released guidance on, and in the previous discussions we had about preparing for today, we talked a little bit about the views you have on those, and I think, John, you had some views on the 4 of them. I thought we might just talk about those in the context of you as investors, as you as long-term investors, because I mean, one thing that I sort of grapple with is, if you are a director and you're up for election every year, then how does that make you think about the company, and does it change behaviour? And Lindsay Mack said this morning at BHP that it's made no difference in the UK, so there's that evidence. But just your thoughts on some of the guidance ACSI's come out with, which is around annual director elections, the ability for shareholders to vote on non-binding shareholder resolutions, a binding vote on RAM policy every 3 years, and the disclosure of the ratio of CEO pay to the median Australian worker.
Oh, I can feel Ian Silk and Louise squirming in their seats here, just waiting for me to go off piste.
Piste, I think you mean, not...
Piste. Piste. Yeah, that's late. That's 5 o'clock,
maybe
right?
Piste as well, I don't know.
All right.
Skiing joke for it.
Sorry. Ian. The question is what we're trying to achieve here. All right. If we're this whole concept of ESG, people talking about like it's a new thing. Now, I remember at Colonial, in our PDSs, we had to include, our commitment to ESG. Like 2005 is maybe even longer, right? So ESG is not a new thing, but we have now conferences, ESG conferences, and there's you get the sense that the ESG warriors think that that's the only thing that's important when it comes to running a company, but there are a lot of things important, running a company, and ESG is very important. So what are we actually trying to achieve here? Are we trying to achieve, some sort of by handing asset owners a bigger stick, we're going to get better engagement with companies? Well, it's not going to work for UniSuper. We've got fantastic engagement with companies. We've always had fantastic engagement with companies. I've hired people that have been working in this market for decades. And they've been dealing with CEOs and boards, for a lot of their careers. So we've not had a problem with engagement. We've seen changes that we've made that have been made by companies because of our engagement behind closed doors. The 2 strikes rule is a really, really powerful instrument, right? That should not be abused. Now, having binding, we just don't agree with that, and I would actually use the word overreach. Right? We just got to be careful about overreach. We can't have a situation where you're actually transferring power to people that, quite frankly, shouldn't be given the power. Let's have a look at ourselves. Everyone that have got the power to these votes to lob these proxies in and potentially change boards, are they qualified to do this? When Apple, I remember, the pension funds, the pension funds in the US, talking, when they get on their soapbox, lecturing Steve Jobs about governance, right? Sorry, I'm backing Steve Jobs on this one. So we just got to be careful about overreach here. We've got to let directors govern, okay? The checks and balances, I'm just too worried about now the pendulum swinging too far the other way.
Sonya? Excuse me.
I do acknowledge there's always a risk with the two strikes policy, especially that it can be used as a protest vote. And I think that's something we're all concerned about. We exercise our votes and our decisions in a very measured, thoughtful, and direct way. The risk is you get activists or others that maybe use that opportunity to exercise different views on different issues that aren't related to remuneration. So I think the idea that a rolling 3-year vote on executive pay structures and strategies, to me seems quite a sensible step forward to try and get that engagement, get it very forward focused rather than backward looking, and have more quality conversations about aligning it to the long-term strategy and to the culture that will drive long-term performance.
Mark?
Gosh, it's a controversial area. I was thinking about this on the weekend in preparation for this, and I think this is really all about trying to work out how do we hold boards accountable. And we've got mechanisms for doing it. And in effect now the remuneration vote is really a vote on what we think about the board. There's a process around it. All of us will say, no, we don't do that. We only vote on the remuneration structure and whatever. But there's always these other considerations going on. So just stepping back a bit, I said, well, what should the boards be responsible for? I don't think we've really answered that question and been really clear what the board's responsible for. I sat back and thought about it and I thought, well, you'd be responsible for the strategy, appointing the CEO, the financial performance, and oversighting the culture of the organisation. That's sort of the 4 things I would think about. So if you can't work out what a board's responsible for, or I think we need to work out and be clear about what boards are responsible for and what are shareholders reserving as their rights. And then how does the shareholder hold the board to be responsible for those things? Now it's all sort of caught up in a bit about this and a bit about that without really being clear what we're trying to achieve. It's not unique to Australia, but I think a more mature conversation about what are shareholders seeking of boards, what are boards responsible for, and what are boards holding executives responsible for in the evolving social licence regulatory framework will be a useful conversation.
Yep. I'm going to mention some names to you to get your reaction. So I joined the industry in the early 1990s, and people like Olive Rahn, Merv Peacock, Greg Perry, Peter Morgan, John Hopkins, David Slack, Ken Nielsen. I looked for women, but I couldn't find any. There may be some, those in the industry that long might remember some, but I couldn't. They were the rock star investors of the 90s. They were in, it's your example with Apple. They were in the press telling companies what to do, getting grumpy. They had large portfolios they ran. Some of them then became not so large. But are you the new them? Are you the new rock stars of the investment industry?
Have you seen how we dress?
I frightened you with the Greg Perry thing, didn't I? Yeah.
Sorry?
I frightened you a bit with the Greg Perry reference because you took over from him, I think.
No, well, yeah. I was notionally Greg's boss.
No one's
very
Greg's boss.
notionally. Look, let me just say that different people have different styles, but one thing I believe that the amount of engagement and activism, if you want to use that word, that happens in Australia is completely understated. All right, we look at the American model, where buy 1-2% of the company, make a big song and dance about it in the press, etc., attract more funds, and that's the model. We tend not to go about it that way, and even at Colonial with Greg Perry, he did a lot more behind closed doors than publicly, and he was really, really effective. A lot more happens behind closed doors than the press. Now you say, well, should we be more transparent? Well, sometimes it's not in our members' best interest to actually have a public airing, okay, of all the dirty laundry, right? And it's best to do things, just get the result. That's the Australian way, potentially, of doing things versus the American way of doing things.
Sonya, what do you think?
Look, I think, I think as large pools of institutional capital, we use our scale very sensibly. I don't think I could imagine we would use the press as a tool to try and achieve an outcome. I think our preference is always to start with engagement and collaboration and consultation, and it's a rare circumstance where that collaboration gets to a point where we have to exercise a vote against company directions. And even in situations where we have pursued shareholder resolutions, and I'll use BP as a recent example, where we co-filed in the UK with Church of England and Hermes, seeking emission targets, short-term, medium-term, long-term, and links to incentives for achieving those targets. We did it in such a consultative way that the company ended up recommending shareholders approve that resolution. So even when we get to a point where we think there is some action required, we want to bring the company along and actually help them understand why we think this change is important. So that is definitely our preferred approach, as opposed to a lot of fire and thunder.
Right, so no guitar for you. What about you, Mark?
I agree with the importance of consultation, but also an idea of what you're clearly standing for. But to your question of rock stars, a lot's changed since the 1990s.
Yeah, I know.
And rock stars are very hard to find, except maybe on Max or something, very hard to find. And I was reflecting that rock stars in funds management or investment management are very hard to find now globally at all. So I think it's gone away from the individual to a much more team-based style of doing things, and that's certainly how we like to think about doing our investment work, and I think that's how everybody does it now.
Yep.
It's much less individually based, star-based, and I think if you think about your time, all the managers and whatever, you won't find many star managers internationally now who exist or hire. They're all team-based.
Yep. Well, I think people realise that when that person decides not to work there anymore, the business just collapses. So it's a huge business risk as much as anything. And I think people also realise diversity and collaboration actually, can help you manage risk and make a lot more money. So,
yeah.
I'd like to open up to questions. I think you'll agree we've got 3 super smart, candid, fantastic CIOs here, and I'm sure they would love to have some questions. Yes, we have one here. Could you just say who you are and where you're from and ask the question, please?
Brendan Casey from Rest, and this question isn't connected with the previous comments that Fiona made about all of you, so I don't want to be sucking up. But we heard from Ian at the very beginning how, this is 10 years ago, the sort of conference, it was him and a couple of his mates, and now look where we are today. And so the ESG teams, I think for most of us in our industry, have been growing quite rapidly to the extent where demand at the moment anyway exceeds supply. And for ourselves, we're looking for a responsible investment manager, and it's not easy. So I'm interested though in the role, structure, size of your ESG responsible investment teams, how you integrate them into your overall investment process, and how you're finding in terms of growing or hiring them, and what you sort of look for.
So our responsible investment team is currently 5 individuals, and that includes some of the communication strategies around responsible investment, and governs our impact strategy more broadly, which includes some of the advocacy work and corporate sustainability. The integration is key, and increasingly we're transferring some of what would have historically been considered responsible investment activities over to our investment professionals. And really for us, it's making sure that we give those investment professionals sufficient training to build their deep capability in RI by complementing them with deep RI capability and advisory work from our team, so that it is getting truly integrated. And I think that ownership in the investment team is critical to success, because they really need to understand every day as they're making decisions what the RI lens on that opportunity is.
Mark?
I think we've got 5. And the pressure's always to add. If you think about ESG as risk management, the front office teams must be the front line of these activities, because they're the ones who are meant to be assessing the risk management aspects of the cash flows of these long-term investments. And so I'm keen to get it pushed as much into the investment teams as possible and become part of business as usual, rather than being something being done in addition to the underlying investment process. That's certainly how we do it at AustralianSuper. When you talked about the start of the conference, I think I was there at the first one, and I see Rob over here was there at the very first start of ACSI. I'm not sure whether I saw Trish at the back over there, but these 2 people were pretty influential at the start of ACSI as well, so thank you.
Yeah, look, just to add, I think it can be a bit limiting thinking about a sustainable team, because it's like, you're talking about an innovation team. Everyone's responsible for innovation. Everyone's responsible for sustainability. There are checks and balances there. One thing that we've done that I think is reasonably unique is just appointed Lou Caparelli as head of our team, and Lou Caparelli actually also has asset management responsibilities. So he's got a portfolio that he manages relative to a benchmark, etc. And I think that's a sure sign that you're really integrating the sustainable team with the actual portfolio management activities.
I remember one of my colleagues, Kerry Williams, wrote a paper in 2000 on SRI, back then it was called, and the conclusion was that ultimately we would not talk about this as anything special. It just would be a part of the way we make money for members. It would be return enhancing, risk seeking, or some combination, but we would not have to keep drawing these things out. And that's like 20 years ago, so it's a work in progress. Any other questions? Got two on the table here. Someone rushing over.
Hi, Ariane Barker from Scale Investors. I was delighted to hear your comments about diversity and gender balance and helping to improve outperformance, helping to contribute to outperformance. Have you had any insights as we continue to internalize investments team, given the size of the industry, what has been happening here in Australia, which I've particularly noticed around teams becoming more diverse, more inclusive, more collaborative, versus what's happening overseas with external managers that you may have inherited, or external managers who you may be actively speaking to, and the cultures in those teams?
Mark?
I don't get to see that many external managers now, so it's hard to really answer that. Historically, investment management's been a very male-dominated industry, not as bad as some of the other investment fields, but hedge fund management, for example. And it's been a pretty white-dominated field too, when you look at the people who have been involved in it. Our team looks nothing like that, and we're proud of that.
Look, diversity is something we're very passionate about. You probably know the HESTA membership is 80% female, and so we do a lot of work to try and progress the agenda for our membership. And we take it very seriously internally in terms of our culture and the things we prioritise. Standing here today, our gender numbers, we have over 40% female in the front office investment team, which is very, very unusual. And I think that's a combination of the fact that the organisation is just so well represented in terms of the broad gender advocacy and has a very strong reputation. I think secondly, that when people come to work there, it's very authentic. So there's a lot of policy and flexibility and support, I guess, provided to make sure that we can successfully achieve diversity. The other thing I'd say is diversity for us is now part of our investment underwriting. So when we go out on new mandates, when we're looking at new managers, we assess diversity policies, we assess their strategies if they don't have strong representation, which most don't, let's be honest, I think the reality. We're looking for what they're doing about it, what actions they're taking so that they can demonstrate their intent to change that. And we also surveyed our members last year, and so we now have a baseline of the diversity numbers for all of our external managers, which going forward, our intent is to do that regularly so that we can see if we are actually driving change and whether they are actually improving those diversity numbers, and that will be part of our decision making.
So you actually might move money and might choose to invest with managers that are more diverse than others and specifically do that. So that's a very powerful signal when money flows.
And very strongly grounded in the belief that diversity improves investment decision making, which improves investment returns.
John, what's your numbers?
I agree with all of the above. The thing that we're all struggling with though is just getting at a university level or a school level that investments is a great career for a woman. It's still really not there. We're a long way from that. So we just need a greater throughput. before Christmas we advertised for a quant, not a quant actually, we actually took the word quant out because we said an analyst in global equities. And we said, look, it'd be great. It'd be great to get a woman because, we got 5 blokes in there, etc. 140 applications, 6 women. Okay, and so it's hard when you deal with that number. So we kept on trying. We've actually hired a young woman from Perth, so she's moving. So it's great news, but you've got to really work at it. We're just not getting the throughput, from the universities. We run workshops once a quarter. Eastern Seaboard, and we sort of get 15, 20 of their best and brightest, and we say, can you please get, and it'll be like, 16 blokes, and we're lucky if we get 2, 3 women turning up, and they're all doing the same degrees, they're economics and finance and etc. So then we write back and say, no, look, we just want a higher percentage. So look, I can't put my finger on it. We'd love to get at consciousness at a school or a university level so that women actually see this is going to be a great career option for them.
We agree it's a challenge. Thank you for your efforts.
Another question on that table?
Michael Bray, KPMG. John Price spoke favourably this morning about the potential for integrated reporting to more strategically position ESG risks. Sonya, you touched on integrated reporting very briefly. I was wondering what you had in mind. Was it that a company in which you invest or might invest, producing an integrated report, might give you better information about their long-term prospects for value creation, or is it more that the organisation reporting in more integrated fashion yourself would have a vehicle for demonstrating to members your competitive edge in investment governance and management? Is it both? Is it something else?
Yeah, it's definitely both. So we did our first integrated report last year, and definitely continue to champion integrated reporting more broadly across the finance industry. For us, it's really about communicating that long-term strategy, understanding what the inputs are, and making sure you're very transparent in what resources you're consuming to produce your product or your output, and having transparency around some of the metrics that you're setting to achieve over time frames that are not just the next year, but the next 3 years or the next 5. And I think for me, what I really love about integrated reporting is, it's almost, you can get on a page what makes a company really unique and special, and understand their business model in a way that a 50-page annual report sometimes doesn't achieve. So I think there's a lot of opportunity in really good quality integrated reporting for the future.
Mark or John, you want to add anything to that?
Yeah, I guess we're talking about this triple bottom line type of stuff, etc. I just worry that is it become a box ticking exercise? And to me, it's no substitute for engagement, right? And I said, look, we're at UniSuper, and I know the big funds are all the same. We're in a pretty privileged position where we get to meet whoever we want, all right? And so what's put on a report to us is not as important as the engagement that we have with the leaders in a company, and we take a lot more comfort from that.
Mark?
I don't have a lot to add. I just think that better risk disclosure, with risk being thought of holistically in reports, will be a good step forward.
We have 1 minute and 25 seconds left. If anyone has a super quick question, well, a quick question and with a quick answer. No, I don't think so. Okay. So any final thoughts from any of you? We've got an audience of 350 people here from a range of different organisations. Just any final thoughts for the group?
Things you're thinking about? I think we've got a lot to be optimistic about, and we beat ourselves up. We've got constant reviews, etc., and people talking about, lifting our game. We've done a lot of things right. Where I've worked overseas for a few years. Very fortunate. I was in Hong Kong last month, and there was a few of us who had a private meeting with Janet Yellen, and I got there early, and I had just a personal. And you're from Australia. You guys have got a great pension system, right? And that's I think that sort of says it all. We sometimes beat ourselves up without realising we've actually got something pretty good here.
Yeah.
Look, I just say, I think as an industry, we're in an incredibly privileged position to manage the capital that we do with the horizon that we have in an environment that is aligned. And that is also a huge opportunity for us to take that capital and invest it wisely to generate long-term returns and to use our voice to really drive things that we believe will create that and help businesses understand systemic risk and longer-term risks that might not already be in their line of sight.
I just want to thank ACSI for the incredible job they've done over the 15 years or 18 years. Australia was an early adopter, not the earliest adopter of ESG, but an early adopter, and to see how far it's come and to see it's now become the global standard as to how these issues are assessed is a great credit to everybody involved.
Okay, that's a great note to end on. So join me in thanking our three panellists. Thank you very much.